Hey everybody, we are live. It is Gold Silver Pros here with you today, a special live broadcast for you guys on the day that the CPI hit 6.2%, 30% over, or highest in the last 30 years. The stuff is definitely hitting the fan there for the government. Inflation is not transitory. We'll get into that. We'll get into what you got to do and what we think is coming next. I'm going to let everybody load here into the chat here on our YouTube live stream. Thank you everybody for joining us. This is the live stream. Inflation spikes highest in 30 years, gold and silver up, bonds in danger. We're going to talk about it here in a few moments. Everybody get your questions down below in the chat if you don't mind. If you want to hit us with a super chat and really grab our attention, we will definitely answer your question. Special shout out to the viewer 𝙬𝙀 who gave us did a super chat for us last night. We didn't respond to you last night, but thank you so much, 𝙬𝙀, for doing that. We appreciate everybody that supports the channel. Looks like we're good on sound. Thank you guys for pointing in. Riding shotgun, we've got the Cool Breeze and Michael Sayre, who are our channel moderators. Thank you guys so much for joining us on the channel and joining us on the live broadcast. Again, we're going to give it a minute or two until I get into the actual podcast and the details thereof. We're going to get everybody loaded here in a couple of minutes. In about 4 minutes, we're going to do our first ever Twitter Spaces on the channel, and we're going to broadcast simultaneously on Twitter. If you guys want to listen to our audio, go over to Twitter, look at our feed, and look for the space labeled 6.2% CPI, inflation spikes highest in 30 years. We'll get you Twitter guys loaded up here in a moment. Thank you everybody for joining. Virtuous Villain is here. Sarge is here. 𝙎𝙊𝙇𝙑𝙀𝙍 Collection, 𝙂𝙊𝙊𝙇𝙀, Silver B, Stray Dog at Play, Squirt9, Ralph Potts, Fantana Ranja, Neil Hahn, Jenny Alicia is in the house. Thank you for joining, Jenny. Canadian Limey is here. Blue Dog, Red Dog is here. Ralph Potts is here. Thank you, Ralph, for joining us last night on the private Zoom call that we had for our subscribers and supporters, subscribers of the website and supporters on Patreon. Let's see who else we have here. Timeline 101 is here. Big shout out to everybody. Neil Hahn's usually, as usual, is one of the first ones to join, providing lots of comments. We appreciate you guys. Okay, we're going to go ahead and get started, and I'm going to start the Twitter space here in a moment. Big CPI at print today. First thing, I get up this morning, I see gold and silver spiking. I have people pinging me on Telegram, my friends pinging me on private text. I'm like, okay, what's going on? Thank you, Delta Fox, for the contribution via the super chat. Evergrande just defaulted. Delta, if you have a link, let me know. We're going to talk about that as well. I think they had 148 million coupon payment to today, and there was doubt whether they would be able to make it. So it sounds like maybe the news came out that they just defaulted. 𝙎𝙄𝙇𝙀𝙊𝙎 is in the house from Arcadia Economics. Special shout out to 𝙎𝙄. Welcome everybody. We're going to let more people load. We got about 80 in the house. Awesome guys. For those of you that are going to join us on our first ever Twitter Spaces, we're going to simulcast. That's why I've got the earphone piece in. I'm going to simulcast via my phone on Twitter Spaces while we do the YouTube live. I'm going to take questions via both, so put questions either way. Sarge says, I checked a minute ago, no news, no confirmation on Evergrande. So Delta Fox may have some information we don't, but I expect the news to come out either that or that the Chinese basically had to help them out of the situation. We'll get in detail on that. I got a couple of stories from Reuters for you guys on that today. It's saying that on Twitter, Michael says, okay, good to know. We'll go and look at Twitter that they have defaulted. So that's big news. If Evergrande has indeed defaulted, this stuff is about to hit the fan. All right, guys, I'm going to start Twitter Spaces. We're going to get everything going there as well. Everybody join. Here we go. Microphone is live. Welcome everybody to the live simulcast between YouTube Live, inflation spikes highest in 30 years, gold and silver up, bonds in danger. Welcome everybody joining from Twitter as well. Good to see everybody here. We will get started here in just a moment. We have Michael's in the house, NSD is on. We have other people joining the Twitter. Okay, we're going to go ahead and get started, guys. For the Twitter guys, we're going to enable your mics here in a little bit, but we're going to get into the news of the day. So again, woke up this morning, CPI hit 6.2%. I'm looking at the gold and silver price. They had spiked almost 2% in early trading. Silver went as high as 3%. It was in the 25s. And now, right now, silver's trading 1.81% up. It's holding the critical level of 2450 on that chart, dating back to the last a big run up in gold and silver in 2009 to 2011. So as long as silver holds 2450, we're going to see if it does, then and holds it for a day or two, then that means we're probably in the next leg up on silver. Gold is doing well. It's up about 1% today, up in the 1850s. It's good to see gold and silver trading up, both of them. So lots of news today. Let's get into it. Again, I saw the CPI spike, and then I thought, what about Evergrande? There's a lot of news. I'm going to read you the Evergrande news, and then reports on Twitter are that Evergrande has officially defaulted. But according to what I can find on Reuters, Bloomberg, and CNBC, mainstream media, we've got an article here from Reuters. Evergrande teeters on edge of default as 148 million payment falls due, and it fell due today. Some bondholders have not received payment by end of Asia business. So technically that's a default, according to Reuters. Shares of developer Fantasia plunge. Moody's downgrades Kaisa. So the whole property sector, Kaisa gets downgraded. S&P cuts 𝙎𝙬𝙇𝙑 from BB plus to BB minus. That's basically junk debt. So a lot of the property market in China is being downgraded to junk or just above junk. By the rating agencies, and the whole thing's in chaos. We have reports on the live stream on YouTube that people are reporting on Twitter that Evergrande has officially defaulted. That is definitely going to be an issue, because if that's true, we're probably going to have, it'll be the start of a debt default in China, at least in the property development sector. We'll see what China does, the government and the central bank, whether they try to bail these out. China's already got their think tanks on it. Trying to figure out what to do with the problem, how to address it. So the Chinese government's already considering, in other words, what to do about this. We're also basically, China has asked their state-owned entities to basically bail out Evergrande, Fantasia, Sinic, and all of these, Kaisa, and all of these companies. Some massive problems in China going on. Will this be the final straw that breaks the camel's back and crashes the global debt system? It's entirely possible. This could be, the quote unquote black swan, because I don't think anybody saw Evergrande coming. We did note whenever this Evergrande situation recently started, about a month ago or a few weeks ago when it started, that the Chinese home market, the mortgage market, is $62 trillion. It is the largest single asset class existing in the world. It dwarfs the US stock market, the US bond market, everything. Whereas the US is fairly well distributed between stocks, bonds, real estate, things like that, all about the $30 trillion mark, 30 to 40 trillion. The Chinese invest mostly in the property market. So when this defaults, when Evergrande defaults and some of these other companies default, this is huge. This is the biggest asset class and the second largest economy in the world. This is not anything to be trifled with. So I'm going to invite some people to speak here on Twitter Spaces. If you guys have comments, go ahead and join in. We'll answer questions on Twitter as well as YouTube. This is a simulcast on YouTube Live and on Twitter. Another article from Reuters says Chinese property bonds dive as contagion kicks in. Kaisa requests help to pay investors. Developer met Chinese government think tank in Shenzhen. U.S. Federal Reserve warns strains could hit global growth. So the Federal Reserve's all over it. Investment grade Chinese firms being dragged in. Fitch downgrades Kaisa. So Kaisa's been downgraded by Fitch, and S&P has downgraded another property developer. China's property sector is getting absolutely pounded, and this looks really bad. So that's that. I want to get back into the consumer price index. In the US, the thing that has really freaked people out the fastest is what's going on in the US inflation market. The Fed said transitory. We all called BS at the time. Because like I noted this in the beginning of the year, I was talking about this saying commodity prices are going up. It started in January, February, and really got going in March. Commodity prices were up. I said, this is going to cause inflation. And it blew past where we were prior to the COVID issue. So our prices went past where they were pre-COVID. So it wasn't just restarting the economy. I knew it was going to be worse. Then it hit the PPIs, which are the producer price indexes. And the last 3 to 4 months, it's hit the CPI. 6.2%, the biggest jump in 30 years. This is going to force the Fed to react. And I tweeted that this morning. It's going to force the Fed to react. Now there's an article on CNBC put out here about 20 minutes ago. The first Fed rate hike is now expected as early as July following the hot CPI data. So just like I anticipated this morning, as soon as that 6.2% print came out, the Fed is going to have to hike, they think, as early as July. Traders in the Fed futures market now see the Federal Reserve interest rate hike to be much more likely in July, following a very hot October consumer inflation report, reports CNBC. The first rate hike is priced into the September contract, but the July contract is now nearly priced in. So the futures are reflecting the fact that everybody thinks the Fed is going to hike in July. A second rate hike is expected by December. So the last time the Fed started doing the hikes, a few months after they started doing the hikes in 2018, we had the 20% correction in the stock market. That's what happens when they're going to hike. So I think what happens is this CPI is going to lead to the Fed hiking. It's going to lead to a crash in the stock market, and it's going to lead to a panic. And that's if China gets their bond situation figured out, which I don't think that they're going to do. So it's not only going to be in the US, it's going to be major issues in the world's two biggest economies. All right, if you guys on Twitter are interested in joining, just request to join, and you guys can on the Twitter space, and I'll let you guys pop up. And you can talk right now. I've got a bunch of listeners. All right, to YouTube, lots of questions going on, lots of activity. We've got about 200 people loaded in the live stream. Peter Frohwein says, if we have 30 to 40% who quit their jobs over the vaccine mandates, then our economy will come to a complete stop. That's Peter Frohwein's comment. I agree with you. There are a lot of people quitting due to vaccine mandates. My previous company, this exactly happened. I've been talking to people that worked at my previous company in the telecom space. People are quitting because that company has government contracts, and they issued a requirement that by December 7th, you had to basically get vaccinated, or you can no longer work for the company. And that caused a lot of people to quit. So that is a good comment there. Let's see, any other questions, guys, that you have, throw them into the chat. Gold and silver, big day for gold and silver. It started to track back down. Silver got as high as 3% up. It's tracking back down, but I think it's going to stay elevated over the next probably few days. I fully expect a tamp down in the futures market. That would be traders going short, taking profits. That will also be people coming in, dumping paper. I completely expect that to happen. A good comment here from Sarge, the great resignation is also at play. Yes, there is. There was on November 5th. Remember the 5th of November was not only significant for the gunpowder plot, it was also significant because there was a great walkout. Or was it the 9th? I think that happened right after the November the 5th, that there was the great walkout. People were walking out of jobs. People in unions were walking out on their jobs and saying, we're not going to work here if you do those mandates. So a lot of that's going on to now. We've got issues in the labor market. We've got a tight labor market. Whether it is the great walkout or whether it's wages, people are demanding higher wages. For example, I saw stories that in New York, they were having to pay $18 an hour for people to make pizzas, which is something like 2.5 times I think the federal minimum wage. So people are walking out on their jobs. We're having labor shortages going on at the same time. So a lot of stuff going on in the economy. As I look at gold and silver right now, they're still trading very strong volume and open interest. There is quite a significant amount as of yesterday interest in both gold and silver. There are a lot of price arbitrage going on right now in the form of EFPs in gold, especially. I think yesterday had 2,400 contracts, EFP, which is exchanged between the US and London. So people are taking advantage of differences in the gold price on the stated rates. And that could spike as well because of the news that we have today and what gold is doing today. So I expect a lot of activity on the futures market, and I expect that to continue for quite some time. That's why I expect elevated gold and silver prices. Again, if silver holds above 24.50 today, I think we're in a new plateau. I think both gold and silver, given the Evergrande problems, the awareness of that, and the CPI and the continuing inflation are going to continue to go up. So if you're wanting to get your gold and silver, you may have just had your last dip for a while to buy on, and I'm not sure that we're going to have another one. All right, on Twitter Spaces, Magonia, I have allowed you to speak. So if you have a question, please ask it. Please join in the chat. We'll be happy to answer questions. Also, guys in the YouTube, if you have questions, let us know. Sarge has a question. What will ETFs do to Bitcoin? My thought on ETFs and the derivative, because there's also derivative markets in the cryptos, is that it's going to cause more volatility even than they have now. Remember what happened when we got the derivative markets in the commodity space. It caused extreme fluctuations in price in commodities. I think that there was a letter between Kissinger and someone else that got revealed later on that that was one of the designs of the derivative space. In any case, derivatives on anything cause a lot of volatility because now you open up the casino. What a derivatives market is basically you're going to Las Vegas and you're betting on black or whatever the case may be, whether it's oil, gold and silver, hog futures, and now it's going on in Bitcoin. You've got the ETFs and you got the derivatives. What the ETFs are going to, like they did with gold and silver, they're going to take some demand away from the actual product. And I think the derivative market will cause volatility. That's what I think is going to happen. Comment here from Nick 𝙎𝙊𝙇𝙑𝙀𝙍, load up on uranium mining stocks. Yes, I think there's going to be inflation and demand for uranium. That's something we talked about on the show quite a bit. I agree with you. If you're into speculation, then uranium may be a place for you. 𝙂𝙊𝙇𝙑𝙀𝙍 has a question. Let's hear your thoughts on uranium and its impact on replacing fossil fuels. I think that governments are trying to get rid of fossil fuels because of pollution and the ESG and the environmental programs, the green movement. We see people we see basically the United Nations on COP26 trying to basically ban coal. That's being talked about COP26 right now. There are countries that have initiatives to replace their fossil fuels, natural gas and oil and coal with renewable energies. The problem is from a baseload perspective, as we saw in Texas during the Great Freeze, that they're not reliable baseload power and they're not reliable, throughout the day baseload, especially solar. So from a baseload perspective, solar can never replace fossil fuels, at least not right now, not with the technology we have now. So essentially what's going to happen there, nuclear is the best baseload, per unit or per dollar spent on the fuel, nuclear is the best baseload provider. So we're seeing a renewal in nuclear energy demand. China recently stated a few days ago, I think I had this on one of the videos, that they plan on expanding 150 new nuclear reactors, 150. So the amount of uranium demand that's about to come from China is going to be immense. Uranium bull market is in full swing. Steve Mueller, a super fan and moderator of our YouTube channel, is a big uranium guy, has done a lot of research on it, came on the channel. We've done a couple of videos together. We called the big uranium pop. That's exactly what happened. And, that's what we've got going on right now in the uranium sector. But I think also commodity price inflation is going to drive uranium up, just like it's going to drive the prices of everything up. Again, to recap, highest CPI print in 30 years, 6.2%. I believe somebody reported to me on Twitter that China's CPI was 13.5%. I don't know if that's year over year or what that is, but China, I did find a bunch of articles that China is having extreme inflation. Of course, they're having the debt issues with Evergrande. We've heard reported on Twitter, Evergrande's officially defaulted on that $140 million bond coupon that was reported in Reuters. They likely would. And it seems like they have. The entire property market in China is taking a dive. We've got two downgrades. Kaisa's been downgraded. Evergrande's been downgraded by different ratings agencies. We also have news that the people trading the futures market for the Fed think that July we're going to have a rate increase. I think they'll do some rate increases next year. And as they do rate increases, that's going to put pressure on the stock market. We will likely have a stock market crash as early as next year. We could have it this year because of the CPI, but we definitely will start to have it next year when they start raising rates. It's inevitable. Right now, the bond market is on fire. The US 3-year is up 0.097. The 10-year is up 0.109. The 20-year is up 0.122, all in a day. The US 30-year is at 0.112. The US 2-year is 0.084. So the US treasuries are getting absolutely pounded across the entire sector as the CPI number comes out, because they know that the inflation is going to be bad. They know they're going to have to raise interest rates. So the bonds are already reacting to that. Question from Flame Tongu on YouTube. Why is a USD index going up? Makes no sense, because people, the flight to safety when bad stuff happens, they'll fly to the dollar. That's short term, I think, because if the dollar will eventually come under pressure, especially if there's a stock market crash and the US sovereign debt comes under pressure, that will bring the dollar under pressure. But right now, people are going to flock to the dollar in terms of safety. So I think that's one reason that it's got a little bit of strength, but I'll say that that's probably transitory. I think the dollar long term is definitely on its way out. Any other questions, guys? Feel free to join in. Lots of people joining us. Looks like we have Ninja joining us on Twitter Spaces. We have Wall Street Silver joining us on Twitter Spaces. Michael, from our moderators here on YouTube Spaces. Y'all join in. Feel free to chat on or ask questions on Twitter Spaces, and we'll address them. Long term, what do I think happens? I'm doing a presentation tomorrow on the OTC markets in front of investors invest in the small and mid caps here in the US on the OTCQB and all of those markets. And the title of that is Gold and Silver this time is different. If you guys are interested, I have the keynote tomorrow on the OTC. I think it's about 10 a.m. Central Time. You guys can register on virtual I think it's a virtualinvestor.com on conferences. Can come see me do that. I'm going to give that presentation why it's different for gold and silver. It's funny that I wrote and gave that presentation this week. I did half of the presentation last night on the YouTube channel, the other half for our Patreon subscribers. And we'll do part of it tomorrow on the OTC as well. And it's funny that I did that because everything that I talked about in that presentation about why it's different for gold and silver, it literally the day after this morning started to come true with what's going on in the markets. So it was a very timely presentation I gave. If you guys want to see that, half of it's on YouTube last night. And again, we'll give part of that presentation tomorrow on the OTC market. So just wanted to notify you guys of that. DMSA is preparing bankruptcy too, says Steve, the Cool Breeze on YouTube. Interesting question from Peter Frauwein. Oh, comment from Peter Frauwein. Paul destroyed the meaning of the word transitory. No, he just tried to redefine it, much like Clinton did the definition the word is. So the PPI is 13.5-ish in China. So that's not the inflation rate, but it is the producer price index is 13.5-ish. So that's the number that we got there. So bad news all the way around in China and in the US. Comments welcome, guys. We're going to go for a little while longer. We've got a ton of people in the YouTube chat and a ton of people in Twitter Spaces. You guys have questions or comments, let me know. Lots of, yeah, go for it. Who am I speaking to? All right, Mothman is on Twitter. What's going on, Mothman? Okay, so we got a good question from the Twitter Spaces. I'm going to repeat it for the YouTube listeners since we're simulcasting. It basically asks, is cash a good position to go to? Is the market a good position to go to? How do you position yourself for what we think is going to be a big stock market correction and problems in the economy? That's a good question. If you look at what happens to the stock, I'll answer cash in a second. If you look at what happens to the stock market in a correction, everything goes down, even the mining stocks. So you're going to experience losses in your portfolio. However, stuff that does better are things like value stocks, certain staples, things that people are going to use like food stocks, and the precious metals miners will do very well on the way back up. Those will recover first. So there'll be a short-term correction in those types of things, but they'll start to recover. So I think in the stock market, I'm not dropping all of my stock market investments in the mining stocks. I'm going to keep them. If they go down a little bit, it's okay. I'll just buy more. It's an entry point for me. In terms of cash, if you know that interview that I had a couple of years ago, and then I interviewed him again in January for our solutions summit that we had on Hopin. I interviewed Fernando Aguirre, who was a survivor of the Argentinian peso crisis in 2000. Eventually he got out. He went to Spain and got out of Argentina because they're in another currency crisis at the moment. But they went through this currency crisis. And I asked him this question. I said, what about cash? He said, well, the US dollar did great. Our local currency was crap, but the dollar is great because it's a world reserve currency. And I think in the US, cash will be good for a while. If we do have a big crash and the dollar comes under pressure, and with this inflation, your cash is worth less, but you still need cash because people are going to take cash up until they don't. Up until people decide that fiat US dollars or toilet paper, like they did in Germany and in Zimbabwe and in Argentina, you know, until they decide that cash is going to be king. That's what people know. It's ingrained in their brains for the last 108 years now, since 1913, especially since 1971, we came off the gold standard. So I say having some cash is a good idea. I wouldn't go all cash. If I were holding a longer term liquid position and wanted to reinvest in things like the stock market when it recovers and real estate when it recovers, I go into precious metals. I go into really small denomination gold, and I go into common coins and silver. That's why I park a lot of my quote unquote cash, because during a major financial crisis, Gold and silver are effectively as good as cash. For instance, recently I went down to my local coin dealer. I redeemed some of my precious metals I bought back way back in like 2009. Just some of the stuff I wanted to get rid of, and I had cash literally in 20 minutes. The guy wrote me a check. Part of it gave me cash, part of it gave me check, and I had it right there, and I could have used that money for whatever I wanted. So yeah, stay in cash, quote unquote, but keep some of that in precious metals. And then how you approach the markets really is up to you. It just depends on what you want to do. But I say I'm staying in my mining stocks. They're going to go down a little bit, but I think the pop is going to be even better. So I'm not worried about it. If you're in anything other than mining stocks or some food stocks, some consumer staples, when the big crash hits, you're probably going to have a large hit to your portfolio. Back in 2000, when we had the big tech crash, I was in Janus funds. They were the quote unquote strongest funds that you could have at the time. They had this, whopping 10-year track record. And what happened was I lost 40% in the span of about 2 months during the tech crash. So if you're just in regular ETFs, regular stocks, I would say get out before you think the big stock market crash is coming, which is probably going to start no later than end of next year if the Fed actually raises rates. If they pull the rate raising up, it may come even sooner than that. It just depends on when they start raising rates. So good question there from the Twitter Spaces. Any other questions, guys? I have one here. Yeah, go ahead. Yes. Mm-hmm. Mm-hmm. All right, good comments. Thank you, Ninja. So Ninja came on Twitter Spaces for those of you watching on YouTube and made a good comment about how to play the precious metals and cash based upon, our last question that we had. So essentially what Ninja said, and I'll repeat what he said here for the YouTube live stream. You don't want to wait on your precious metals allocation because what happens is that local market tightens up very quickly. If we have a big deflationary collapse, issues with the dollar, a scare, which causes people to flock to precious metals, they'll run out of available stock really quickly. You're not going to be able to take your cash and go buy the physical precious metals. So you want to get positioned in physical precious metals right now. And then the cash that you want to have, I would advocate 30 days to 60 days, depending on how bad we think the crash is going to be and how quick that, how bad it becomes for the dollar, have that in actual physical greenbacks, the dollar bill that you can pay expenses with, because right away people won't take precious metals, but get your precious metals allocation first, get that quickly, do it before the downturn happens. That way you have it. That way you can go back to your local coin dealer and sell it when the time comes. One additional comment I'll make to what Ninja said there was essentially, we also have to be careful because it's possible that people will want our gold and silver at any price, but it's also possible they may not be able to buy it. For example, I sold recently about $20,000 of the precious metal to my local coin dealer. He wrote a check and gave me some cash. Not a big deal. What if an ounce of silver is $500 and I'm wanting to sell several thousand ounces? Can the guy even buy it? Or if it gets to that point, do I even want to exchange it for cash? So there's really a lot of different things to think about how you're going to play precious metals when the crash first comes and how much cash you want to have. Everybody, it may be different. Just know what your expenses are, know what your obligations are, especially mortgages and contracts that are in dollar terms, and how you're going to pay that off, and know that how you're going to exit your precious metals position. And adding to Ninja's point, make sure that you have networked with your coin dealers to know who's going to be able to buy you out of precious metals. Like, for example, if you want to exchange gold and pay off your mortgage, if you're wanting to sell some silver to get whatever the currency is to buy groceries, make sure that you've got a network of local guys that you can sell that to. Because it may be at some point, it may be, if it gets really bad, your precious metals are worth more than any amount of money that people can give you. So that's why I say keep a little bit of cash on hand at first, and then your precious metal, but network and make sure that you have people that you can sell that to. And I also think one other point I'll add, I think the black market in precious metals is going to get going really strong. If we actually have like a Zimbabwean event in the US dollar and it stops being the world reserve currency, and the dollar is not thought of as the premier currency, I think your ability to barter and your ability to know people that you can exchange your precious metals for is going to be absolutely key there. I think that's going to become very important. That's another thing that Fernando told us about Argentina. Yeah, gold and silver were valuable, but what was almost more valuable at some point when supplies ran out was your ability to trade services for services. I can fix your plumbing, you can fix my car, that type of thing. If it gets that bad, your skills and your abilities and your network is really going to matter in that type of situation. John Percy has a question here on YouTube live stream. Do the bullion banks continuously roll their shorts? What would force them to settle? Yes, the bullion banks roll their shorts. About every 3 months, you have the big contract. So December is the big contract, but in gold and silver, it's going out to February, March already. They continually roll it. All the producers do as well. If they're hedging their short-term downside price in the silver they're producing, they'll roll it too. That's normal to roll the contracts. What would force them to settle? Well, they don't have to settle. According to COMEX rules, if a long wants delivery and stands for delivery, they can settle in the physical if they want to, but they can also do cash. That's written into the contracts. And I think that the exchanges have forced cash settlement at times. We've heard that from traders on the market, even though that's not printed anywhere for us to see. We've heard stories about them forcing cash positions. So I guess as long as the bullion banks have a good cash position, they can always settle out their contracts. Sarge says, Rob, in Venezuela, they're shaving gold for food. We're taking 1/4 grams. It does keep it barterability. Please learn fast when people learn fast when they're hungry. Yeah, exactly. They do. Anything of value you can trade for food. Definitely. Bullets. If you want to get into the whole prepper discussion, having bullets will be extremely valuable. Alcohol, cigarettes, chocolate, things like that, if you want to stock up on that stuff now. Hopefully we don't go full Mad Max here in the US, but it's entirely possible. All right. Anybody else? I think we got somebody else requesting to speak. AM Premier Prop Solution on Twitter Spaces. Please speak up. If you've got questions, feel free to ask. Oh, yeah, I can hear you. Go ahead. Mm-hmm. Gotcha. Yeah, so comment on Twitter for those on the live stream is it's a reentry point, I think what you said is when we have a crash and everything comes down, it's a reentry point to get back in. I agree with that. It's a prime reentry point. Once the market crashes, getting back into your silver funds or your silver mining stocks or whatever the case may be, it's a perfect time to average yourself back in at a lower price. You can, if you can time it correctly and you can sell out of your existing position somewhere near the top and then get back in after the crash, that's a good thing to do. If you feel like you can do that. Timing is always tricky though. Sometimes on the way down, man, stuff goes down super fast and it's like, crap, I should have sold yesterday. Yeah. Yeah, that's a good comment. Having dry powder, not spending all your money now, not fully taking your position now, if you're going to be talking about the funds and things like that. I 100% agree. That's a good comment. Thank you for the comment. I think Mike came on as well, or he requested to speak. So Mike, if you have a question or a comment, please let us know. While we wait for Mike, Anders has a question on YouTube Live. He says, Rob, what is next for oil? Sorry for my spamming. No problem, Anders. Thanks for spamming your question. We've seen you on the chat quite a bit on YouTube. So I think oil is going to spike. Hold on just a sec, Mike. I think oil is going to spike. I think inflation is going to drive it. Although if we get into a deflationary recession, oil could go down because usage will go down, especially if it's a worldwide deflationary global depression. Oil will come down in the short term. If we then have military action, which usually follows a deep depression like it did that my father was in World War II, if we get to that point, it will spike back up. But I think oil is going to fluctuate pretty wildly. I think in a regular inflationary environment, a stagflation environment, it goes up. We have a deflationary crash, it's going to go down, but then it'll pop back up when people start getting back into oil. All right, go ahead and ask your question, Mike. On Twitter Spaces, Mike, do you have a question or a comment? Good comment from Kristen on YouTube. I live off my crypto, haven't lost yet, loving it. So Kristen is independent, roaming the world after she left her job. Yeah, go ahead. We can hear you. We can hear you, Mike. Just turn up your speaker so you can hear us. So what do you guys think is going to happen to inflation? I'll ask this both on YouTube and Twitter. Do you think we're going to have higher than 6.2? I've said I think it's going to keep going up till we get to double digits. What do you guys think is going to happen? So comment from Twitter Spaces, 10 to 15%. What do you guys think is going to happen to the CPI on YouTube Live? I think Shadow Stats has it at about 13 to 14%. I think that may be a tad conservative when you look at the 1980 way of measuring inflation, but the CPI, go ahead. Mm-hmm. 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 Yeah, I agree with you. A good comment from Ninja, who's joining us on Twitter Spaces. He said it's a natural inclination for humans when things hit double and triple digits that people go crazy. So for example, when Bitcoin hit double digits, people will go crazy. When it hits triple digits and 100,000, people are going to lose their minds because there's a psychological points, right, in our numbering system. You know, when you go 1, 10, 100,000. And he made the comment that when you hit double digits in inflation, people are going to lose their minds. And I think so too, because I don't think dating back to what was it, the late 70s, the last time we had really high inflation. And that I was born in 74. So I remember growing up in that environment when everything was tight. When one of the good benefits of high inflation was cheaper mortgages, because the prices had to come down for people to afford them, even though interest rates were insane. I think they got up to like 17 or 18% if you could afford that. But basically everything was going up so fast. People, we almost got back to that Great Depression era where people were making their own clothes and stuff like that in the 70s. I remember growing up and I was a single parent family. My mother was a secretary and we could barely afford our house. We had to make our own clothes, couldn't afford, we had one car that was always broken down. We had to walk everywhere. And this was as I was growing up. And this wasn't that long ago, about 40 years ago. So if we get to double-digit inflation again, the one thing I worry about with more people living in cities and being less self-sufficient, how the US people react when we hit double-digit inflation. I think it'll be worse than any time in history because less of us have gardens, less of us know how to fix things. Most of us are living out of 2 days of food in our pantry, don't have $400 in the bank to pay a bill. How are we going to deal with double-digit inflation? I think it's going to get really bad at some point. Yeah. Yeah, comment on Twitter Spaces that we had riots during single-digit inflation, just general economic inequality, even some political, political diversion, that kind of stuff going on. One of the things that Jennifer, who is our account manager, has a degree in government and political science from Harvard. And she said, Rob, she remarked to me the other day, she said, Rob, I think that we're going to have more demonstrations. It's not just going to be BLM stuff. It's going to be everybody. You're going to see people from all walks of life demonstrating, at your local town halls, marching down streets. It's just going to get worse. And that, she's saying that from an historical perspective, because that's what's happened in America when this kind of stuff happens. If we talk about conjunctive waves, every 80 years, we have a big event. Last one was the Great Depression. The one before that, the Civil War. The one before that, the Revolutionary War. About every years, we get through that winter season, we have that time period in which you have more protests. You have the people stand up against the government. You have political party change. The political parties change quite a bit during those times. Lots of things will change. And I think we're in that period again. It's been about 80 years since the last time we had our big economic and political event. It's time for another one. And I think, we're smack dab in the middle of it right now. And I agree. I think that we're going to have some additional protests. It's going to get a little bit more violent. I don't want to get too far into that end of the conversation, but just learn to protect yourself. I've been taking Krav classes for the last 2 years and forced my daughter, who's now living on her own, she's an actress, forced her, because she's just a little old thing, about 110 pounds. I forced her to take some Krav classes with me so she knows how to defend herself. So those types of things, just the general stuff that you do to can make yourself a little bit safer. We have another speaker coming on Twitter Spaces. Go ahead. I believe it's 𝙎𝙊𝙇𝙑. So the question over Twitter Spaces is, what are the factors that will lead to a higher price environment for oil? So I think if you look at the energy crisis going on in Europe and in China, there is some substitution effect between fossil fuels, but not a lot. Oil is better for transportation. It can be used for grid power, but mostly it's used for transportation. Other parts of oil mine, like kerosene and things like that, are used for heating homes, like in the Northeast and in the North in the US. So depending upon what component of a barrel of oil you're talking about, of course, you've got kerosene used in aviation as well. You got propane and butane and all those things. There's a lot of demand for the oil that comes out of the ground. I wrote an article about 10 years ago on Seeking Alpha that talked about, I looked at all the data, the worldwide data that we had on the oil reserves. And I said, it's going to be a lot harder to get it. We have enough, but it's going to be harder to get. It's going to get more expensive. That has come true. I think it is permanently higher. I don't know that we're going to get back down to $40 a barrel unless we have that deflationary depression, because there's so much demand. And getting it out of the ground, there's something called EROI, and that's energy required. Or in other words, how many barrels of oil does it take to get a barrel of oil out of the ground? Or how many, units of oil does it take to get oil out of the ground? Because we have to spend energy to get energy. That EROI number keeps going up, meaning every time we go to oil sands, every time we go out in the sea and have to go deeper into the ocean to get it, it's more expensive. So we use up more energy producing energy. That's one of the big reasons that EROI is going up. The exploration dollars it takes to find, new oil. A lot of it's being found around Africa. Africa is politically unstable in a lot of areas. It's hard to get deals done with those guys to get their resources. There's a lot of corruption that goes on, a lot of payoffs that go on. So where we're getting the oil is, from a jurisdiction perspective, there's more risk. So all of those factors kind of go into it. And then the futures market is a big problem because those guys are looking to make a profit. So if they see a rising oil price, a lot of times they bid up oil. That's why oil went up to $140. The last time it did is not because it actually cost $140, because the futures traders were trading it up until the point that a bunch of them sold and it crashed back down. So you've got the whole futures aspect of it also. The thing that will stop oil's rise is going to be a deflationary depression. That will stop it in its tracks. But what will happen after a deflationary depression is regional wars are going to kick up and there's going to be additional demand for it. So when it comes back down, I don't think it's going to stay there. Good question from Twitter. Yeah, usually. So the follow-up question to that was, is it a catalyst for wars? Oil itself, if you look at the Middle East conflict, it was one of the catalysts for that. But I don't think oil will be the catalyst for the next war. I think it's going to be at first, it's going to be a casualty of the war, and then eventually it will spike up and everybody will want oil. I think what's going to cause the next war is a big economic issues. That's basically what was causing World War I and World War II the last century, were economic issues. Also, World War I especially, changes in national governments from royalty type models to more democratic models based upon what had happened in America. That was a lot of what drove World War I. World War II, a lot of it had to do with Germany and the reparations and all the damage that was done to Germany, and the German people suffering for so long, and that giving rise to extremists in the German party, which took control. And all of the economic equality that was thrust upon Germany was a large reason for that. Anytime you see big economic inequality, anytime you see effectively Cold Wars going on between nation states like we have between the US and China right now, that's usually what gives rise to your wars. Mm-hmm. The question on Twitter was, is oil a big deflationary hedge? I would do, inflationary hedge. It could be, yes, because it will go up, but oil will be traded based upon demand, not necessarily based upon strength of the dollar. Strength of the dollar will affect oil price, but I would rather have gold and silver. It's been the more reliable inflation hedge, and even gold as a deflation hedge as well over the long term. Okay. Yeah. So a question on Twitter was the relationship of silver to housing and land. And you stated that an ounce of silver basically bought, what was it, 35 acres of land? In the Louisiana Purchase deal, the comment on Twitter Spaces was that, yeah, I'm just restating for YouTube. So the comment was that an ounce of silver bought 35 acres in the Louisiana Purchase. Now, Louisiana Purchase is a pretty good deal for the US. I would say that they got it pretty cheap. But in other words, an ounce of silver bought you a lot back in the day. And the question basically is, I assume the question basically is, are we going to get back to that point? And the statistics that you gave were, well, was it 2.8 billion ounces of above ground silver? A little over 1 billion houses in a world. So that seems to have flipped. There's, more silver than houses, meaning silver is functionally undervalued. Is that your comment? Mm-hmm. So the question, okay, I got you. So the question is, will silver buy a house? Will gold buy you basically a city block? I would say yes. I would say if it goes to a really bad scenario where we have hyperinflation in the US and the complete death of the US dollar, which I think will happen. If you look at Sir John Glubb's research on the rise and fall of nation states, every 250 years, We have a new currency regime, which is something I talked about in the video for our Patreon subscribers. Yes, I do think that silver could buy you a few ounces. Silver could buy you a house, and gold could buy you an apartment building or a residential city block. I think if you've listened to Lynette Zhang on her channel, ITM Trading on YouTube, she's talked about 1 ounce of gold buying multiple commercial buildings, in other currency devaluations in other areas of the world, according to her research. So precious metals get extremely valuable when everything else is cheap and you have that currency crash and that deflationary depression. That's the perfect time to exchange your precious metals for other assets, because then what happens is you recycle. Precious metals will eventually come down, the other assets go up. This is the asset trading cycle. That's why I got out of real estate in 2018. I sold all of my rental properties in 2018. I was a little early, but I wanted to position myself early and not worry about it. Now I sleep at night and don't worry. Eventually I get back into real estate. I'm not buying real estate right now. It's just too darn high, but there'll be a time when I get back into real estate. And that time will probably be a few years from now, after we go through this next deflationary cycle and what I think is going to be a destruction of what we now know as the dollar. Yep, you're welcome. So let's see if anybody on YouTube has any comments or questions. Yep, no additional questions on YouTube. We're going to wrap this up in a minute, guys, because I have an interview with Brian at London's Gold newsletter here at the top of the hour. So I got about 5 or 6 minutes. So if any questions, I'll give it another couple of minutes and then we'll go ahead and wrap up both the Twitter Spaces and the YouTube Live. I think we're cranking 300 concurrent viewers on YouTube. Thank you, everybody, for joining the live channel. Appreciate you guys doing this. This is spontaneous. We just planned this a couple hours ago. But based on the news, reiterate while we're here, based on the news of 6.2% CPI that was reported today in all of the financial press, the highest inflation surge in 30 years in the United States. There's an article here on CNBC that big business bosses are warning that the supply chain issues and inflation are here to stay. As I've stated over and over again, that the people that are running corporate America know that supply chain and inflation are not going away. We have news on CNBC that the Fed funds futures market is pricing in a rate hike as early as July of next year. And I think when they start hiking, they cannot stop, and it's going to eventually crash that stock market. Reiterate that we have news on Twitter that Evergrande has officially defaulted on that $148 million payment. I can confirm that it was due, according to Reuters, $148 million bond payment for Evergrande, the Chinese developer. So we think that they've defaulted. They've been downgraded by one of the rating agencies. Another company, 𝙎𝙄, who's a developer in China, has been downgraded from the S&P, and Moody's has downgraded Kaisa. So the property market and the bond market in China is getting absolutely slammed. They're in deep trouble. This may be the beginning of the unwinding of the big bond bubble across the world. And remember, this time it's different. It's different because all countries are investing in each other. The commercial sector is invested across the world together. If one country's bond market goes down, they're all going down at the same time. It'll be a worldwide contagion when it happens. This time is different. That is the title of my presentation I'm giving on OTC markets tomorrow on virtual investor conferences. If you want to attend that, go to virtualinvestorconferences.com, sign up for that OTC presentation. I'll be the keynote tomorrow morning. I believe it's 10 a.m. Central Time, 11 a.m. Eastern Time. Okay, we've got another couple minutes left. Any last questions on YouTube Live or on Twitter Spaces? Mm-hmm. Yeah, there's a good comment on Twitter Spaces about oil. There is oil available for sure, and the companies are maybe not making the choice to grow their reserves. I agree with that, but if you look at the OECD data, the data from the U.S. Energy Information Administration and others, the oil is much harder to get and it costs more to get it out of the ground. So much like gold and silver, we're finding less of the easy to get stuff. Much like copper, we're finding less of the easy to get stuff. A lot of these base commodities that we use are getting harder to get. They're going to get more expensive. The cost of energy, the cost of labor to get this stuff out of the ground, whether it be energy or the base metals or the precious metals, is going to continue to go up. That's what's going to drive inflation, because remember, as commodities go up, it's transmitted through the supply chain to the producers and then eventually to the consumers. So higher cost base on it. We're not out of oil. I'm not sure that we're at peak oil in terms of production. We've hit it in terms of exploration for damn sure. We know that, unless we get lucky and find some additional supplies. Wanted to thank everybody on Twitter Spaces for joining. Thank you so much for the comments and questions. Thank you everybody for joining via YouTube Live. We appreciate it, guys, very much. I'm going to go ahead and log off. This has been our Cowboy Metals Live, where we broadcast from the great state of Texas and we take no bullshit, here on YouTube and also on Twitter Spaces. More content coming up tomorrow. I got a really cool, interesting research piece for you guys on YouTube tomorrow, so join us. Thanks everybody for joining. We will see you guys next time.